Hello, this is Bill Moreland with BankReg Data. Today I'm going to spend a little bit of time talking about BCB Bank. And today is July 28th. They just recently filed a call report. So we got brand new Q2 data. It's a publicly traded bank. Ticker is BCBP, as in Paul. Why? Why am I picking this bank? The reason is last week we got a bunch of calls on EagleBank. And so EagleBank, could you have seen this coming? Yeah, we could have seen it coming. So basically what happened is Eagle reported their second quarter numbers and they were not very strong. And the main thing behind this was they had to take a huge reserves and charge-offs. And how could we ever have seen this coming? And so you see this right here. It's our second quarter reflects the execution of our previously communicated strategy to resolve challenged loans. Challenged loans. These are loans that are having problems, right? They're delinquent. Huge credit losses. They had to take charge. Basically, they did a big reserve increase, rose to 2.38%, up 75 basis points. So EagleBank, and so we're still looking at Q1. They've not filed a Q2 call report as of this morning. So we can see EagleBank's delinquencies were way up. We can see that they'd restructured 5%, 4% of their loans, right? And so you can see that the non-performing loans were skyrocketing, and they're skyrocketing across multiple portfolios. How could we have ever seen it? That's one guy right there, exact dollar amount, 2-3 quarters in a row, not making payments. So either the guy's on interest only or the guy's just not making payments. You got to take a charge off, right? So you can see across every single portfolio, there's another guy barely making payments. Across every single portfolio, or a lot of portfolios, you're seeing issues. So you come in and you look at the provision, and they're basically, just now took a big provision number. Just now. Otherwise, they were doing quite well. Then you look at their pre-tax net operating, and they're not making tons of money, but they were kind of making a little bit of money, but they're not reserved. Go into reserves. Reserves to NPLs, 65 basis points. How far down is that? The bottom, 97th percentile. If we add in their modified loans, because they're doing a lot of that, they're at the bottom, 99th percentile. So how could you have known? Well, it's pretty easy to see, which brings us back to BCB Community Bank. Okay. So here's a bank. Its total assets are shrinking every single quarter. So it kind of tells you what's happening. You see the tear sheet, asset quality is lit up like a Christmas tree. They're having some liquidity problems. Charge-offs, allowance, provision, all lit up orange, which means they're in the bottom 20%. Come down here, what do you see? Century shows lots of restructured debt, a lot of early stage problems. Come down here, our major and minor threshold alerts. Once again, look at it. Delinquencies, 4.09% are modified, left on non-accrual. This is crazy. Remember what I said in a prior video about once you cross 2%, your failure rate goes up to like 28, 29%. In the last cycle, this bank's upwards of 4.1. Good thing they don't have to report anymore, right? And here's a more insidious thing on performing loans. Let's say that in Q3 and Q4, this bank no longer has to report modified loans, right? Just rolling 12. We no longer have to. What happens when somebody falls off loan modification reporting? So we modified them a year and a half ago. They made 12 consecutive payments. We took them off. Then they come back into delinquency. Guess what? There's a pretty good chance the rules allow a bank to modify a previously modified loan. Yeah, no one's really thought that through, I don't think, right? So anyway, looking at this bank, you see that they're lighting up every single thing. So let's just start working through. There's your delinquencies. They're clearly scaling back on lending. Look at the delinquencies up. Look at the restructured debt up. Come in, look at early stage. Are they having, across the board. Multifamily's getting worse. Mortgages are still high. C&I addresses, or this is C&I domestic, a little bit better, but still very elevated. Look at the construction loans just went in. Look at late stage, cycle back up through. Non-owner occupied's way up. Multifamily's up. There's one guy. Where's the payment? This is a lot like Eagle, right? Where's the payment? And there's the 3753. So something came in here. So look at that. 3575, 3575, 3575. How? How is the dollar amount identical for over a year and a half? It's either making interest-only payments or the bank is just not taking a charge off. Something else dipped in there, and then we're right back into that guy. So that $200,000 guy, 150 dipped in and went back out. But you're looking at problems in every single one of their portfolios. Look at that, 8%. So now let's go in and we'll look at the modifications. So we're going to go back to the total. We're going to go back to modified. They're just extend and pretend, right? So 160 of delinquencies, 5.51%. They've modified another 120 in almost all of it. Remember, this will show up there. So out of 160 million, there's another 120 million in a separate extend and pretend bucket. So when you look at this, this is total delinquencies plus extend and pretend. It's upwards of 10% of their book. All right, income and expense, pre-tax net operating, they're booking, but they didn't have any profit in Q1. Q2, the number's bound, but why? Provision, they took a big provision in Q1. That's why they didn't make any money. But look how their provision numbers come down. So even though their provision numbers come down, we saw delinquencies climbed, right? We saw delinquencies climbed $11 million. Did they take a charge off? Yeah, they took more charge offs. So net position is coverage ratio. They're sitting at 45 cents on the dollar, which is the lowest they've kind of ever been, right? If we add in the extend and pretend, we're at 22 cents. So reserves are at $50 million, which is identical to last quarter's 51. Meanwhile, they added $50 million of additional loan modifications and delinquencies, or NPLs. Where are they at nationally? The bottom. So when you sit there and say, could you have seen that EagleBank was going to probably have to start setting aside some more? They're going to have to start taking charge-offs. Well, yeah, look at the non-performing loans to charge-offs. This is basically how many dollars, and this is really skyrocketed right there, but how many dollars of charge-offs or how many dollars of NPLs does the bank have for every dollar of charge-offs? And they're sitting at $23 million. So, of course, the charge-off number is going to have to go up, but it's still sitting at 18, which is almost 3 times what similar-sized banks are. So it's a good bet that BCB Community Bank is probably going to end up having increased charge-offs later this year and increased provision later this year. If you have any questions, please reach out and give me a call. Thank you.